Thank you very much, Mike, for that kind introduction, and thank you all for coming here on a warm summer's evening when I'm sure there's a lot of other tempting things to do rather than listen to me. But anyway, what I'll do in this presentation, talk about the company in general, the business model, what we're trying to do, what we have done, and then a small amount on our latest set of results, which of course, was last December now, so it's quite historical. Our interims come out at the beginning of September. Okay, so the background to the company. It's a company I set up in '97. I'd worked for Big Pharma for 20-odd years, Ciba-Geigy and Sandoz. And I left when Novartis was created with the idea of setting Alliance up. The concept was to gather pharmaceutical assets together, build a business plan, and develop the company on a buy and build model, which is what we've done. So that now, 16 years on, we're profitable, we're cash generative, and we pay a dividend. I mentioned that buy and build has been the model, and the buy side has certainly been very active, 27 acquisition deals in 16 years. But what's also very important about the way we manage the company is keeping a balanced portfolio. We have to be very selective on the products that we will decide to invest in and grow. If you did that across your whole portfolio, your profitability would be very low because of your high marketing expenses. Conversely, if you promoted nothing, then you wouldn't be very exciting at all. So our balanced portfolio has got two halves. The active managed part, so we've got dermatology, and I'll talk about these a bit later, but there's 4 areas where we're actively growing products. So dermatology, specialist secondary care, which tends to be around cancer, ophthalmology, and consumer health. But very important is the bedrock of products that are passive. So they are well supported. We keep them on the market. We keep them up to date scientifically and technically, and liaise with the regulatory authorities. And we do supply chain management, etc. But they just respond to the pull-through of people wanting product from us to service prescriptions. Sales are mainly in the UK, about 80% is in the UK, but we do sell to 30-odd countries, mainly through distributorships. Often when we buy a product that might have been for the UK, the previous owner had it also exported to 2 or 3 countries, and we take those in. But we do have direct presence in Germany, France, and Ireland, and we have 2 joint ventures in China. Our aim at the moment is to become pan-European, which means to have feet on the ground in the 5 big EU countries, so UK, France, Germany, Italy, and Spain. And we started that initiative in 2012 by setting Germany and France off, and they have both got products now and are profitable. In our sort of business, you tend to have to build your country company up independently because the mature products in one market, and these are products that might have been on the market for 30 or 40 years, they will be different to the ones, say, in our home market. So our general managers in France and Germany are 75% of their brief is to build the company through acquisition. So they are looking for acquisitions just as we do in the UK. It's a virtual model, so we don't have manufacturing, we outsource that. Logistics and warehousing, once again, outsourced. That is a diagram. I won't go through it all. It's in the presentation that you can pick up afterwards. But what's important is that every year for 10 years now, we've made at least 1 acquisition. So whilst you might think there's a risk in the business model that you might have a fallow period on acquisitions, and that's a valid risk. The track record is that for the last 10 years, every year we've had at least 1 acquisition. What you'll also notice on there is often you'll see the same company down 1 or 2 or 3 times. Reputation and networking are very important in the acquisition business. So if somebody has dealt with you in the past and they were satisfied with the transaction, that it was handled fairly, and that you were efficient and you integrated their product into you efficiently without any reputational loss, then when they have something else to divest, you'll be on the list. They'll never come to you and say, just take that without any competition. There's always some competition involved. So that's the balanced portfolio. Very important is the bedrock at the base there, and that's the UK non-promoted products, which are about 35% of the company. Dermatology is promoted, secondary care is, some of consumer is promoted, and virtually none of international is promoted. That is existing business that pulls through. So we've got about 60% of the passive part of the portfolio and about 40% under promotion. Our aim is really to have about a 50-50 mix there, so that you've got about half the company's products growing and giving you organic growth to compensate as well for the acquired growth. And if we look at our acquisitions over the last 5 years, the blue there are the bedrock non-promoted products, the green are the promoted ones, and there's roughly a 50-50 split of the acquisitions over the 5 years have fell into one or two of those categories. And that's what we will be aiming to do as we move forward. We'll be picking up products that boost the bedrock and give us cash flow that enable us to promote products. And we'll be picking up growth opportunities as well. In terms of the financial structure of the company, this shows you the past 5 years. You'll see that our gross margins are roughly in that 55 to 60% range. And it varies from year to year just according to product mix. Our SG&A or operating expenses have been growing slightly in recent years because we've been bringing more promoted products in. If you go back 5 years, about 20% of the company was under promotion. Now it's 40, so there's a slight rise there in the SG&A for that promotion. But nevertheless, we managed to maintain our EBITDA in that 25 to 30% range, and it varies from year to year according to demands on the company and the progress of products. But our plan is always to keep EBITDA in that 25 to 30% range. And so when we budget each year and allocate out resources into promotion and various other activities that we have to do, that's our aim, to keep EBITDA in that range, which I think is a very healthy EBITDA percentage. One of the things you need to understand about this business is because we're buying products that have been off patent about 20 odd years, they are niche brands that were never taken out by generics when they came off patent, let's say 20 years ago. These brands can go on and live for a long, long time. The average age there of our top 10 by sales value is 46 years, albeit there is Ashton and Parsons infant powders at the bottom, which came out in 1890, and that skews it a bit. But nevertheless, it would be about 38 years if we excluded that one. So these products that we buy, these brands, have a very, very long life. Within the company now, we're over 60 products, so this gives a fair amount of diversification. You can see there that concentration is no greater than 12% in any one product, and that is Hydromol there. And then you're into the Opus Stomach Care range, then Forceval, then MacuShield, etc. Okay, the products that we're promoting to grow, to give you a bit more understanding of those. At the top there you see a range called Hydromol. It's a range of emollients used in dermatology by dermatologists, dermatology nurses, used to keep eczema at bay. People who have dry skin are more prone to eczema. Big market in children, big market in the elderly. But it's a complete range of emollients. We acquired that from a small company called Ferndale in 2006. They were changing their strategy. It was only selling 900,000 then. It's selling over 6 million now. And in 2014, it grew at 15%. I'll come on to the consumer products. I'll deal with the consumer ones next. If I go back 5, 6, 7 years, we had one consumer product, a cough product called Pavicol D for diabetics. We have picked up quite a few consumer products over the last few years, and we actually like them. They're very long-living brands. Anbesol came out in 1890. We took it from SmithKline Beecham. They'd had it we took it from Reckitt Benckiser, who had previously taken it from SmithKline Beecham. And that product had suffered. Its production had been constrained by very outmoded equipment. And we basically took it with another product and gave very little value to it. We've re-engineered the product, made it easier to produce, did a joint venture in terms of investment with our contract manufacturer in new equipment. And then last year, in February, we had a situation where we could supply the whole market, and the sales grew very rapidly last year. It's a product that's used for infants who are teething or fractious. If you look at the statistics on people who try teething products on their children, it's the one that's got the highest level of repeat business. So you might infer that it's the one they're most satisfied with. The next product along is a product called Anbesol, used for mouth ulcers and any other painful condition in the mouth. A very good, strong brand. It's growing slowly at the moment. We haven't promoted it. We've been revamping the packaging. And maybe next year we might start to promote it. It gets active support on social media, and there's quite a cult around Anbesol if you go into social media. It competes in the same market as Bonjela. It's the number 2 to Bonjela. Then you've got Lipsil, another product from 1890-something. It's the one that everybody thinks of as a lip salve. It was used by Sir Edmund Hillary on Everest in 1953. It's like Biro or Hoover. People think they've got it in their pocket, and when they get something out, it's not. So incredibly well-known, terrific awareness. The brand itself had gone into disrepair, really, when we took it from Novartis about 18 months ago. The mechanism within it wasn't working very well. They'd taken it far too far down market. They tried to make it attractive to teenagers and overdid it, and it became attractive. Appealed really only to 8 or 9-year-olds. Sales are growing slightly without any promotion at the moment, but we see a lot of potential in that because the awareness is so high. So many people have heard of it. Indeed, when we made the acquisition, so many people, like friends and relatives, wow, you've bought Lipsil. In fact, it was a very small acquisition for us, but it was one they all recognized. I'll come on to ophthalmology and MacuShield in the next slide. Specialist hospital, we got 3 areas there. So what you see there is a range of stoma care products. So if you wear a stoma pouch, there's various products that help you live with that pouch in terms of being a barrier cream to stop the plastic sticking to the skin, solidifying agents for the discharge, adhesive removers, etc. And so we bought that 2 or 3 years ago, and sales are performing well in a fairly competitive market. The next product there is Gelclair. If you have radiation or chemotherapy for cancer, particularly neck and mouth cancer, your mouth can get incredibly sore and raw, such that you can't eat. Gelclair can put a film around the mouth and soothe it and enable you to eat. And that product's been growing regularly, about 10% a year since we took it on in 2010. The last product is Immucyst for bladder cancer. It was a product that was our biggest brand in 2012. It's licensed in from a large multinational called Sanofi Pasteur. In 2012, they had production issues at their site in Canada and had to shut down because of regulatory pressure and remodel the whole plant. So 3 years on, the product is about to come back to us in the second half of this year, or it'll be the fourth quarter now. But it was our biggest brand at the time. There are competitors out there, so it'll not rush straight back up to become our biggest brand, but there is really good demand for the product, and it's a crucial part of the armamentarium against bladder cancer. So I said I'd come back to MacuShield. This was an acquisition we made this February. The macula is the tiny spot at the back of your eye in the retina where your central vision goes through. And that macula is lined with what we call macular pigments. There are 3 pigments. They are carotenoids. They come from nature. They come in your diet. And they filter out blue light, which can be very harmful and can damage photoreceptors in the eye. It can also mop up free radicals, so any oxidative pressure that's happening within your body that once again can damage the back of the eye. These pigments can mop those up. And people who have dry AMD, age-related macular degeneration, very often it's because these pigments are very, very low. You can measure the density of these pigments. Opticians, ophthalmologists can do that. And if they see low macular pigment optical density, as they call it, then they will put their patients onto a product like MacuShield. There are other macular pigment products. This is the only one that's got the 3 pigments in it, and the mesozeaxanthine is the one that's most important at the very center of the macula. There's other areas developing also for the product. It improves your ability to see contrast. Your eye test is black and white, but in daily life, you're looking at different contrasts, different shades of gray or blue or whatever. And by filtering out blue light, you can actually improve your ability to respond to contrast. It's going to become quite useful in that area in protecting against glare. People who have, and opticians tell us that quite a lot of patients come in saying they have real problems driving at night, and these macular pigments can help there. So it's a product that's growing incredibly well. It's a central part now of our growth portfolio, and whilst at the moment 75% of the sales are in the UK, we did in the deal pick up about 27 different territories, many in the EU, plus other countries that I've mentioned there. So that's a major growth opportunity for us. So that's told you about the business model and the halves of the company, the bedrock that supplies cash, the growth products that, if you like, consume some cash to get them to grow. Whilst this is history now, I'll just quickly show you the last set of results that we had. So the summary of the 2014 results, revenue was 43.5 million. The previous year was 45.3, but there was a difference in the way joint ventures were accounted for. And also 2013 benefited from one product that comes on tender every 2.5 years, and so 13 was a heavy year, 14 was a light year. Gross margin, I mentioned that range, 55 to 60, so you see 57.5% there. Our operating profit was 11.8 before one exceptional item, which was just the write-down of one particular product. Pre-tax profits 10.8, so not a lot of difference with us between operating profit and pre-tax. We got relatively low finance costs. EPS 3.36, free cash flow 10.3, so very high conversion from profit to cash flow. At the end of the year, our net bank debt was 21 million. It had been 25 the previous year, and a gearing of 1.6 times EBITDA. We do use debt to fund acquisitions, but we do keep the gearing certainly within 2.5 times EBITDA, and we haven't been up at that level for quite some time. If you look at our recent acquisitions, they're generally funded out of cash flow. Whilst we might use debt, by the end of the year, 12 months on, the debt levels come back to where it was. And our dividend was up 10%. We've been growing the dividend at 10% now for several years. So it hit the significant level of 1 penny last year. Some of the sales movements, Hydromol, the dermatology product being grown, so that grew 15%. New Seals is a low-dose aspirin product in Ireland, and it was a very big brand a few years ago. It's had a gentle amount of generic competition. It was a 5 million product. It's now a 2.5 million, and you can see it lost 500,000 last year. Ashton & Parsons, as we improved the production volumes, it grew from 0.4 to 1.4. Lipsil, which was acquired at the end of 2013, we had the first full year there, so that was an extra 1 million. Ironat, a product bought in Germany for thyroid disorders. It was its first year, so that was 0.8 of a million. The toxicology product, the one that was on tender, it was the low part of the life cycle, and also the loss of a tender with other people coming in. So a big difference there, 3.8. And then the others roughly holding their own. And as you add in the China joint ventures, because the accounting regulations change, you get 45 to 45. I'm now moving into question time, so I'm not actually going to spend detail on the next slides, but you can see these in the presentation. This shows the underlying profit sales growth over the last few years, excluding one product, Delta Cortral, that was just a blip in 2010. And it had a bigger impact on profitability. So it looked as if we've been treading water a lot more than we actually have if you take Delta Cortral out. And then the income statement you can look at in the presentation pack, and then the cash flow, high conversion to cash. And summary, it's a business model that stood the test of time. We've had quite a few headwinds over the last few years, and it's withstood those. We've got good organic growth opportunities within hospital, ophthalmology, consumer, and dermatology. And we're seeing a high deal flow of acquisitions, and we've got 18 million of an acquisition facility there approved by the bank, waiting for the right deals to come along. So I'll stop talking now, but I'll move on to questions if anyone's got any.
Could you wait for the microphone, sorry?
Do you have any policy on acquisitions? I see you've acquired since 2006 on an annual basis. Is anything aimed at or acquired?
I mean, the policy is that we're looking for things that are established. Products that, if you like, that marketing risk has been taken out of them. So products that are well established, where you can see what you're getting. Clearly, some products are growing and we like those, but we also like ones that are steady and don't need the promotional spend on them. We've been widening our scope since 2012 when we put general managers into France and into Germany. So we're seeing a lot more European potential deals now, and we've made acquisitions in France and Germany since 2012. We did a scan of the last 12 months deal flow, and 75% of the opportunities had some ex-UK content. So that shows the international part of the business is starting to develop.
Question just here.
Hi, yeah, you mentioned there was a write-down on one of the acquisitions.
Yes.
How do you indemnify the shareholders against future write-downs or problems with acquisitions? Say, for example, that your auditors came in and looked at an acquisition that you'd made, realised that company that you bought had cooked the books and the price was too high, and there was a massive write-down. How would you indemnify your shareholders to prevent the share price from hemorrhaging?
Well, I don't know if you can indemnify the shareholders.
How would you go some way to
Right,
indemnify
so
them?
we have an exhaustive due diligence process. We have a whole department doing acquisitions. So we've got 2 people who are outward-facing, networking, looking for deals. We've then got a very experienced accountant who, she does nothing else but does the financial analysis of opportunities. We then have another person who does the marketing appraisal of opportunities. And then it moves from there up to the senior team to review So we do a lot of due diligence to try and make sure that we don't pick up a pup like that. We look very carefully at the sales pattern of something we bring in. So, and we write it into the contracts that if we see the last 2 months' sales jump up just before we buy something, which means we're going to get nothing for 2 months because they've stuffed the pipeline, we've got measures to recover that. So we put that in contracts now. The rest is really just looking carefully at the products to make sure you pick up good acquisitions. Every year, our auditors do an impairment test of every deal we've done. And the small write-off we had there, which was a small product, Pavicol D, because it needs reformulating and also the manufacturer closed down, so we had to find a new manufacturer. Because of those two factors on a very small product, that was our first write-down we ever had.
Yeah, another question?
Yeah, I appreciate the clarification on that point. The obvious point arises, A, are you planning to increase the R&D spend year on year so that there's organic growth in addition to the inorganic acquisition growth? And thirdly, what would happen, because if you've got an acquisition-based model, that would potentially leave you open to becoming an acquisition target in your own right. And what would happen if a potential acquiree looked at Alliance and decided that the breakup value was greater than the retention value? How would the board react in that instance?
Right, okay. I mean, your first point, I mean, we don't do R&D itself, but there's a lot of promotion goes into growing products. So within our budgeting process, we balance the amount of money we put into promotion so that we keep EBITDA within that 25 to 30% of sales range. And so that's a very careful process. We wouldn't pile into promotion and damage the profitability of the company. In terms of, you know, being the subject of an acquisition ourselves, well, you can't hide away from that if it's going to happen. You would hope that your shareholders appreciate that the ability of the company to carry on growing by acquisitions means that your market cap and your enterprise value are actually greater than the sum of all the acquisitions you've put in. And indeed, I mean, we tend to buy products in around between 4 and 6 times margin, for instance. Our PE ratio at the moment is well in the early teens, and therefore there is a perception by shareholders that the value is greater than just the sum of the products. But I mean, that's true of any business, isn't it?
It is, but if they get an offer at premium, you'd be surprised how fast the world changes after time.
Well, quite. I mean, that's capitalism, isn't it?
Any other questions, anybody? No? John, your share price has gone up quite a lot the last 2 months, gone from 38p to 60p.
Yes.
So your market cap's now about 130 million.
160.
160 million, sorry.
Yeah.
I can't do my maths. And liquidity is not an issue. You do have quite a lot of shares. What's suddenly moved the share price? Is there some gossip out there? There's an acquisition on or your interims on the 9th of September are going to be fantastic. Is there something out there, do you think?
I know of nothing that's driving it in terms of information. As one of those graphs showed, we've rather treaded water in terms of profitability for the last 3 or 4 years, and we've had several different headwinds, all of a different nature, that we've had to manage through. And I think that made investors quite nervous about us, and we had a very low rating, PE of 8 and that sort of thing. And I think there was a sense this year that people were seeing that the headwinds were abating. And I mean, we issued our July statement on the first half year, basically just confirming that everything was to plan. There was no new information there, just that the numbers that the analysts had were valid. And it's really since that announcement that the share price has started to move, and there's been some very big transactions, a couple of £1 million worth at times being bought and sold in one transaction. So there's been a lot of trading through July. I can put it down to nothing else than confidence. There's certainly, I mean, we're always active on deals. But there's no news out there that there's a deal pending or anything like that.
Like the market to most companies have been unkind, but it's been certainly kind to yours. So.
Yeah, but
Yeah.
they can go up and down.
Today.
I mean, we're not sort of saying, oh, that's, it's going to stay there.
Yeah.
It might. We hope it will. Very much so. But we're not running away with it. Put it that way.
That's good. Anybody got any questions? No? Thank you very much, John.
Okay,
Thank you.
pleasure.